Welcome to the Whitwam Wealth Real Estate Podcast. Today's episode is Hard Money Tips.
Welcome to the Whitwam Wealth Real Estate Podcast with Scott Whitwam, your blueprint to financial abundance. Settle in as we explore the mindset and methods for wealth building through real estate.
Welcome back. I'm Scott Whitwam, and today our topic is hard money tips. Today I'd like to discuss other people's money. In particular, hard money, but also we'll talk a little bit about private money. And first, for our newer investors who are listening or watching the podcast, let's talk a little bit about what hard money is. Hard money is non-traditional money. So, for instance, I'll get a lot of new investors who say they want to buy a rental house, or maybe they want to do a fix and flip. And they think that the way that they need to do this is go to their major bank or maybe go to a mortgage banker or mortgage broker and get pre-qualified for an investment loan and find out that they're going to have to put 20 to 30% down in order to purchase it. They're going to have to go through full qualifications and pay all of the expenses related to a full qualifying loan, the appraisal, the underwriting, the mortgage fees, the broker fee, all of that. Well, hard money is a little bit different than that. And the reason why we use hard money and why it's called hard money is because it's first off, it's much more expensive, but the loan terms are much more beneficial. And because it's more expensive and it goes, it takes away some of the problems. It's going to cost more. That's the more expensive part. But it also takes away a lot of the, I would say, qualifications and expenses on the back end of it. It's a lot different process. So, for instance, let's say you're buying a house and you find a hard money lender. The hard money lender goes, okay, we'll lend you the money based upon the current value of the house compared to the after repaired value of the house, and we'll give you 50% of that, 60% of that, 70% of that, some of them all the way up to 90%, whatever the hard money lender's terms are. Generally, they're qualifying it based upon the house, the hard asset. And so the loan is going against the hard asset. It's not going against your credit. It's not going against your payment history. So you could have had a bankruptcy. You could be somebody who's habitually late on making, payments on their credit cards. Generally, you're going to be able to find a hard money lender that'll lend you the money based upon the house. Obviously, if you default, they get the house. They are going to require, generally, some skin in the game. And I say generally because it's not always necessarily the requirement, but they're going to require some skin in the game, especially if you're new at this. So this is the first deal you've done with that hard money lender. They're going to require you to be fully invested because they're looking to make sure that they make their money on the higher interest rate that they're charging you versus repossessing your property and having to sell the asset themselves. So hard money is simply bypassing the regular traditional qualifying money programs and using the hard asset, the house, in order to get money to acquire it. Now, again, it does cost more. And, the terms are a lot different. And so it's very important that you understand the process. So here's tip number one. Don't get married to the first person you meet. I mean, that's good advice in life. I mean, you didn't, the first guy or girl you met, you didn't go, hey, let's go get married. Let's just get this thing settled right off the bat. No, it's not the way it works. You got to know people. You understand who they were, how they operated, how their life model is. In our case, the business model. So this is going to be the same thing with hard money lenders. So with hard money lenders, all of them operate differently. Some of them require, 50% in the game, skin in the game. Some of them 40%. Some of them only 10%. Some of them will go 90%, of acquisition, and they'll loan you 90% of the rehab money. So, I mean, all of them are different. The thing to do is to do your research and talk to more than one person. There are hard money lender brokers out there that can help you with this. Now, obviously, they're going to get a fee. They're going to get a percentage of this, and whether you pay the fee or the the hard money lender pays the fee, there is going to be a fee that'll be an upcharge to you when you're borrowing the money. But since there's no qualifications in the process, when you're comparing these things, expect that the terms could get, on some ends, very restrictive. So, for instance, some hard money guys may say, hey, we require 50% down. Some hard money lenders require you to have a credit report pulled. Some of them are looking for, 640 and above credit scores. Others are looking for 700 and above credit scores. There's a lot of hard money guys that could care less about your credit score. Most of them will not require a full qualification, so you do not need to provide taxes and income proof. But what you'll probably have to do for many of them, not all of them, is provide what we call a coverage qualification. So they're going to want to see that you've got the money to make whatever down payment that they're requiring, your skin in the game. And then they're probably going to want to make sure that you have enough money in the bank to cover the repairs that need to be done. Many of the hard money lenders are going to require that you have a construction budget. So let's just say you're buying a property for $500,000. If they require 20% skin in the game, you're going to have $100,000 to cover the down payment, your investment portion. Then if it's $50,000 in repairs for the property, they're going to require you to have another $50,000 in cash. Now you got to have $150,000 in cash. And then they may require you to have a buffer for carrying. Some lenders are going to be like that. There's going to be other lenders who just want to make sure you've got the money for the down payment. Make sure you've got the money enough to acquire the property. So they're all going to be different. All of them are going to have different programs. Some hard money lenders have what they call points. So they have a low interest. Maybe they have an 8% interest attached to the hard money product that they have, but they require 2 points. Maybe, they require, 90%, they'll do 90%, but they require 1 point. So you have to understand and compare all of the different hard money guys together. And again, don't get married to the first person, but compare them all. Compare whether or not your hard money guy is going to give you money for 6 months, 12 months, 24 months. What is their term before renewal or before the terms change? Some hard money guys say, hey, our hard money loan is for 12 months max. And if it goes over 12 months, then they have a premium penalty that they add on to it. They may require a renewal fee, maybe $1,000, $2,500 to extend and renew the hard money loan, and then an uptick in the interest rates. It's not unusual to see hard money interest go up to 18 or 20% on some hard money lenders. Same thing with private lenders. A private lender can be a hard money lender, but sometimes we look at them a little bit different. Maybe your uncle is interested in investing. He says, "Hey, I'll loan you the money at 15%," and he's not going to require anything down. He's not going to require any credit checks or anything. He just wants the 15% off the project that you're doing. So I would compare all of these and find who you want to work with. Maybe reputation's a big thing to you, and so check out the reputation. Maybe get hold of other investors. Ask who they are using so you can use that in your comparison. Tip number 3 is don't over-expect. Don't go into a project, don't get under contract on a project expecting that you're going to be able to just go out and find a hard money guy who's going to be competitive with, fully underwritten money. So if money in the marketplace, well, right now we're talking, it's close to 7%. So 6.5% to 7% would be typical. Investor funds are about 7.5% to 8%. I wouldn't go acquire a property expecting that you're going to go find hard money for 8 or 9%, unless you're expecting to have a big points participation up front, unless you're expecting to have to bring a really large down payment in. So you may be able to find the interest, but the other terms may be more restrictive. I would say don't over-expect. One of the things that I find with, a lot of times with novice or new investors is that they got under contract and expected to be able to find competitive market, fully underwritten type interest rates. And little down payment for hard money. Hard money guys are taking a much greater risk in the marketplace, so they're not going to give their money away cheap because they're not fully underwriting you. They're not getting your tax returns. They don't care about your W-2s. They don't care about, how much money a month you make. They're not doing all of that fully underwritten. So they're taking a bigger risk in lending their money. So don't go in over expecting to find hard and private money extremely cheap. Now, if you do have a private money source, we'll say uncle, mom, dad, that kind of thing, yeah, maybe you can work out something that's competitive in the marketplace. They're making more money investing in you than they are in their passbook savings, and so you can get that deal. But most hard money guys are not going to be there. Tip number 4, have your ducks in a row. Obviously, if you're experienced, it'd be really easy for you to have a spreadsheet with maybe the last 25 deals you've done, maybe the last 50 deals you've done, just a spreadsheet in there that you can send to the hard money guy, especially if you haven't done business with this particular hard money guy you're talking to now. And now they can get an idea of your profile, your risk profile. You obviously got experience. You're going to be less risk than somebody who's never done one. If you haven't done one, I would say, have your ducks in a row. Have your bank statements or your investment statements where you're going to be pulling the money from. Where are you going to get the down payment to put the skin in the game? Where's that coming from? It doesn't necessarily have to be you. It can be a family member also. It can be an angel investor. It can be a JV partner. But I would say get that money into an account, get a statement that shows how much it is, get a letter from maybe a line of credit that says, hey, you've got $250,000 in a line of credit. Have these things ready. Have, what experience you do have. If you've done one or two, I would have those listed out. Hey, we did this one. We purchased it here. We sold it here. We purchased it here. We put it into debt service loan contract here, whatever. Get your ducks in a row so that when you're dealing with a hard money lender and have chosen one you want to work with, you look serious, you look professional, you look like you know what you're doing. What you want to do is you want to try to minimize or reduce the risk that is in the hard money lender's mind. You want them to be able to quickly profile you and give you an estimate or give you a quote on what the money's going to cost. And if you have a good profile set up, they can get that. They can assess it quick. They send you back and go, hey, this loan's going to cost you 14%. We'll go 9 months, no points, 1 point, those kind of things. And you can get the back. They'll tell you that, hey, you've got to have a certain amount of coverage for the repairs that need to be done. They'll give you the information that you need so you can make a decision. And it's much easier when you have your ducks in a row where they're not having to send you, 5, 6 emails saying, hey, can you also send us this? Can you also send us that? Hey, you forgot to send us this. Do you have, that? The other thing is for hard money, you're going to need an LLC in order to avoid some of the lending regulations, the fully qualified lending regulations. So you're going to need to have, a company of some kind. So this would be a good time if you have never used hard money and invested in real estate, you're just getting started. This is a good time to go out and set up your business, your LLC that you're actually going to borrow the money in. To get the paperwork all done. So you have the certificate, you have the articles, you have an operating agreement, you have all the documents that hard money lender's going to need. So get your ducks in a row. Tip number 5, make sure the numbers work. I have had people who have tapped into hard money because they thought that the project was going to take them 60 days and that their deal would sell within a couple days of being on the market, and the numbers would have worked barely if all of that was true. But you've got to make sure the numbers work. What happens if the project takes you 90 days or 120 days to get? Maybe there's a material shortage. Maybe there's a labor shortage. Maybe there's a problem in the home when you open it up and something you got to deal with and fix. Now the project takes a little bit longer. What happens if the market's slow? I mean, we're in a pretty slow market right now nationwide, which is kind of unusual. Prices are still up, but the market's slow nationwide. So what if we get into a slow market and your property doesn't sell in 3 or 4 days, but it sells maybe not even in 3 or 4 months, but maybe it takes 6 months to a year to sell? Now, I know that we all, as investors, we're all positive. We know that our stuff is going to be the best on the market. It's going to sell the quickest. But I have talked to investor after investor after investor here in the last couple of years that have had properties sit on the market 6 months, a year, more than a year. Hard money guys telling me that they've taken back more properties from investors during this period of time than's normal because they got overly optimistic. And the numbers didn't work unless they hit this very perfect pipeline. So I would say make sure the numbers work. You're better off to pass on a deal that is extremely tight if you're using hard money than you are to try to take it down and not have an exit solution in case everything doesn't work out perfectly. I don't want to have to see. I don't want to have to see you, lose something, have something repossessed, have one of your first deals out of the gate go sideways because the numbers didn't work. Because you got excited about the deal, you got excited about the property, you got excited because the hard money guy sold you because of any of those type of things. Let's make sure the numbers work. Let's make some money on your acquisition. You're much better to make a smaller amount of money and make sure the deal works, but have your numbers cover, than you are to go in hoping to make a home run and then find out that you've got a strikeout and you lose big because you overestimated, especially in the market that we are right now. There's a lot of opportunities here, especially even working with hard money. Particularly, I guess I'll throw this in as final thoughts. I mean, there are times when we take down properties with cash. We just pay cash for them and we do them. It makes sense. But I like the idea of using other people's money. And if you do it right, if you follow the steps, if you do it right, if you look at things, make sure the numbers work. Don't fall in love with the first person you find. Do your research. Have your ducks in order. You can really make hard money work. And using other people's money, you can generate profit and because of leverage without having your own money at risk. And so, again, I would just make sure that you follow the process and don't get out over your skis, right? Don't start bringing your dreams in. Make sure you stay and maintain a little bit of reality in your transaction. Hey, I want to thank you for joining me on this episode of the Whitwam Wealth Real Estate Podcast. Be sure to check out our growing list of previous episodes and other real estate investing topics. I invite you to subscribe today, be part of our growing community. You can always find the Whitwam Wealth Real Estate Podcast on Apple Podcasts, Spotify, iHeart Podcast, YouTube, or wherever you enjoy listening to podcasts. This is Scott Whitwam. Be sure to join me on the next episode of the Whitwam Wealth Real Estate Podcast, where we're wealth building through real estate.